This video is going to discuss a simple law of physics. Force equals mass times velocity. And it applies to all facets of nature and the markets as well. I have a 19-month-old son, weighs about 30 pounds. He's a little quick guy. But if he ran into you, guess what? He probably won't even budge you. He wouldn't knock you over. I'm 6'4" and a half, 245 pounds, work out. If I ran into you, I probably would run you over. Unless you're a 400-pound linebacker for the NFL team. Same concept applies to the markets. Because we statistically analyze every currency versus every other one, in this case we're looking at the euro versus the dollar, the euro yen, euro Swiss, euro pound, euro CAD, euro New Zealand, euro Australian, and we're comparing the dollar to all those pairs too. We know the mass and the velocity of all those pairs. So if the institutions that move the markets, we just are along for the ride, are buying the euro against all the pairs and are selling the dollar against all the pairs, and they're doing so on a massive scale. It shows up on your charts. So the euro dollar's trend was up, and it's just kind of going sideways right here. This basically shows there's not too many euro pairs going up or down, and the bottom one, the FX momentum, shows the intensity of all those movements on all those currencies on each bar. So this tool basically lets you know, usually within 1 or 2 bars, whatever time frame bar you're using it on, whether it's a 1 minute, 2 minute, 3, 5, and it works on longer term, 15, 30 hour, and 240, and even longer than that if you choose. So when you see this market break out right here on this bar, notice there wasn't that much volatility in that bar, but the bar after it right here, the majority of euro pairs were going up, dollar pairs were falling, and they were doing so with more intensity than they've had over the last 12 hours and maybe even longer. So if you got into that breakout, this is telling you that there's a good chance that the trend's going to continue up. And if you missed that initial breakout during this pullback right here, initially there's quite a few euro dollar pairs going down and dollar pairs getting stronger, and then it subsides. But notice on the way down there was not much volatility to the downside. In other words, the force of this move is up. Most euro pairs are going up, dollar pairs are going down. They're doing so with incredible intensity. And during this little pullback over the next 20 minutes right here, initially a lot of euro pairs are falling and dollar pairs are going up, but they're not doing so with any intensity whatsoever. So this is a decent place to get in. We really have 2 methods that we use to enter trades. We find, using our currency meter and this tool and other tools, the strongest and weakest currencies, and we want to buy the strongest versus the weakest. And we either buy on a pullback or during a multi-hour sideways range. So let's look at this. If you bought this pullback right here, initially there's not much strength or weakness, but there's a preponderance of more green bars than red. So if you would have bought that little pullback right here, your stop's underneath the swing low. There's not much weakness at all. And as it goes up, again, look, a very high percentage of euro pairs are going up, dollar pairs going down, but with about average intensity. You might have got out of your trade here when it went sideways for a while, and then when it finally broke out of this little range pattern again, notice during this time a large percentage of euro pairs are going down, dollar pairs are getting stronger, which means this is likely to go down. But during that time they also did not move much they didn't move down with much force. So when this breaks out, the previous momentum and force was to the upside. And you see this right here, very high percentage of euro dollar pairs are going up, decent momentum, and anytime you see some big red bars coming in, you might want to tighten your stop underneath each level, right? And notice this explosive move right here. Almost every bar, most euro dollar pairs are going up, and the dollar pairs are getting weaker, and they're doing so with pretty decent intensity. So you just stay with this trade all the way up. Here's an even better example. Market's going sideways and breaks out. Now notice initially as this starts to go back up, there's not much participation. Some of the pound pairs are going up, but not all of them. Not all the dollar pairs are weak, and the intensity is not that strong initially. But coming in right around here, there is extreme. Almost every pound pair is going up, dollar pair is going down. That's very helpful information to know. That means the institutions are buying the pound and selling the dollar against almost every other pair. At that given 5-minute bar, this is one of the strongest pairs. and so you tighten your stop up here. You might have got out when it went sideways. Very strong momentum to the upside, pulls back and you get back in. Again, a very high percentage of pound pairs are going up, dollar pairs are going down, and with decent intensity. And usually you want to draw your fibs on most of these moves and get out of fib targets, or you can, every time it makes a higher high and pulls back, 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 you just tighten your stop along the way. But this tool showed you on this move up here a lot of pound pairs going up, dollar pairs weak. Initially the intensity was there, but then it dried up right here. Notice as it was going up, it's very good to know that the momentum that is pushing this currency up is less than an average amount. So this is exactly how you would use it if you drew your fibs on this wave right here and it comes up to the Fibonacci profit target level, and it does so with less than the dotted white line, less than average intensity, then guess what? This is probably going to be the end of that particular wave. And notice on this pullback right here, what a great trade that is. One of the best ones of the day. Went up with a very high percentage of pound pairs being bought and going up, and dollar pairs being sold and weak. It slowed down its upwards momentum, but during this pullback a very small percentage of pound pairs were actually even going down. Some of them might have been going sideways up there. This shows you that across the board the pound isn't that weak. And underneath here, not only is this very small percentage of them going down, on some of these bars, the net effect of those bars was up. Some of the pairs might have been underneath the previous bar's low, but some of the pairs actually went up. You have green right here. And so when it breaks out and goes up, you initially don't have a super high participation, and then you do right here. And whenever you have a very high percentage of pound pairs going up, dollar pairs going down, and doing so with very strong momentum, it's usually a good trade. And you can see this buy right here, maybe somewhere around 95, 94, went up all the way up here to 65 area. So that was a 65, 70 pip move, very, in my opinion, accurately telegraphed ahead of time by the momentum always being to the upside, the thrust moves always having the most momentum to the upside, and that's it. Now let's look at the same chart on a 30-minute chart. It works on all time frames. Notice as the market's kind of going sideways even before that, most of the thrust moves were to the upside, most of the high momentum moves were to the upside, and when this market broke out right here, initially it went up with a very high percentage of pound pairs going up, dollar pairs going down, but without that much momentum initially. But the trend's clearly up. You got a trend line underneath the lows here, and when it broke out of this range right here, notice a very high percentage of pound pairs are going up, dollar pairs are going down on a 30-minute bar, and with decent momentum. And so, on the longer term chart as well, this telegraphed the likely continuation up, and because of the momentum and the volatility on the way up, and again, not much weakness here as it goes sideways, very little intensity to the downside, nothing. Intense moves up, very little intense moves sideways or down, and that is what led to this continuation move. Now notice up here at the highs, it came up, it's a little bit extended, it's gone up statistically too much, pulled back, went up again, and notice on this bar right here, even though a high percentage of pound pairs went up and dollar pairs went down on that bar, they did so with an extremely tiny amount of momentum. So anytime you want to look for a counter trend trade, once you see the momentum slowing like this, it really adds to your probability of being able to better time selling the highs of the move. You want to put your stop right above that bar's high, whether it's a 5-minute bar's swing high or using a 30-minute or hourly bars, whatever. Whether you're a short-term scalper looking for 5 to 30 pip moves, or you want to get into a couple-hour trades and your goal is to find 30 to 80 or 100 pip moves, this tool really helps you find that. Now notice on this bar right here, even though it closed down, not too many pound pairs actually broke the previous bar's low, but once it took off right here, a very high percentage of pound pairs are going down, dollar pairs are going up, but they're not doing so with that much momentum, so you would want to tighten your stop, and because the trend is up, when it starts going sideways, you want to bail on the trade. Notice this one right here, euro yen, Nice little trend line underneath the lows there. This one was kind of trending up slowly, and the momentum was to the upside. The volatility wasn't that high, and when it broke out right here, a very high percentage of them went up with decent momentum. And then on the next bar, the percentage of euro pairs going up, yen pairs going down, decreased, and the upwards volatility was almost nothing. Notice this big red bar right here. Almost every euro pair was going down and yen pair was getting stronger, and it did so with decent momentum. And so that is a very high probability reversal signal. This pretty much stayed red or had no green whatsoever, and most of the down bars had much more volatility and momentum to the downside than the up bars did. And look what you get. And notice when it broke that trend line right here, almost all the euro pairs were going down, all the yen pairs are going up, and they're doing so with incredible intensity. That usually means, from what I've seen in trading with this, in the next bar or two, and I mostly use it on 5-minute charts, so anytime you see a big move, this is showing high participation going that direction. Almost all the pairs are going your way, and they're doing so with decent momentum. Usually within a bar or two, it makes a lower low if you're short, or a higher high if you're long. And notice after this exploded down, it went up. A very high percentage of euro pairs went up, yen pairs went down during these bars. But guess what? The momentum move in the thrust in the mass and velocity was to the downside. Very little momentum on the way up. And so when you see this start to break down right here, a good trend continuation re-entry. And initially a very high percentage of pairs going down with decent momentum. And as it starts to drift down right here, some of the bars, there's not much net. We call this the tipping point for a reason. This is usually the direction price later tips. And when it comes down with decreasing momentum, you might want to tighten your stop. Your odds of catching another big, huge monster trade like that go down when you don't have a very high percentage of currencies going your way, and when you don't have momentum going your way. To repeat, this video describes my mass times velocity when it comes to trading currencies, because we analyze statistically every currency versus every other one, and we're measuring on any given bar, whether it's a 1-minute bar, 2-minute, 3-minute, 5-minute, 15, 30, hourly, 240, whatever. We're seeing whether those bars are going up or down, and we have a proprietary tipping point algorithm that statistically measures this. And then we compare each bar with all those currency pairs and how far it's moved compared to the past for this bar. So it's dynamic throughout the day. During times where the market does not move much normally, we're comparing today's current move to the past low volatility. And during times where the market's usually active, UK session, Europe, US, during those times when the market typically moves more, we're comparing those real-time current bars to the past volatility for that time frame. So in other words, if the euro dollar normally goes up 10 pips during this bar, but the euro dollar goes up 15 pips here, it would show 150% volatility. If the euro yen does the same, and the euro Swiss and euro CAD and so forth, then that's what the FX momentum is going to show. It's going to show 1.5. If some of them are going up and some are going down, then that diminishes this. And so what this means is some pairs could have exploded up here with a lot of momentum, but other euro pairs might be actually going down. That's what this is showing. And it's a very powerful tool. No tool out there works 100% of the time. And the key to trading is small losses, big wins. But when trades do work, typically you'll find some big moves. And when they don't work, as you can see in this case, well, this trade actually worked. You would have done well on it, but it didn't continue in the same magnitude as before. But it's good to know that ahead of time. This tool works in real time. Once you get into a trade, if you don't see a high percentage of currencies going your way and not having real-time momentum, you might want to bail on the trade. Here's the dollar Swiss on a 3-minute chart. It's going up. You got a little wedge pattern right here. You don't know what the future is going to hold, and then it breaks out of the little wedge pattern. You go long. More dollar pairs are going up than are going down. More Swiss pairs are getting weaker than are getting stronger. And initially it does so with decent intensity. But as it continues up, you can see, there's occasional bar or two that has good participation. There's not much momentum behind this trade. So you wouldn't really expect this thing to rip 30, 50, or 100 pips. You would tighten your stop, and when it comes up here and makes a little double top, you might want to get out of your trade. but it's a small 20 pip move. And this tool clearly showed that, with the exception of a few bars, there wasn't a preponderance of dollar strength or Swiss weakness, and for most of the move there wasn't much intensity behind the move. Here's another example using a 5-minute pound yen chart, and the market rallied up, and we have a nice little sideways consolidation here. During most of this sideways rectangle pattern here, most of the pound pairs on most of the bars were going up, and most of the yen pairs were weak. The intensity showed, one decent sized move here, and again this compares it to this time of the day. No real extreme intense moves down, but the majority of the bars were green in terms of the direction that each pair was moving. The trend was already up on this pair, and when it broke out right here, you notice that most of the pound pairs are going up, yen pairs are going down, and they're doing so with incredible momentum. And then the same thing on the next bar, made a higher high. Even more pound pairs are going up, yen pairs going down, but with less momentum. That's what this is showing. And as it goes sideways right here, notice the percentage of pound pairs going up, yen pairs going down lessening, and the volatility is kind of lessening. And so, the odds of this thing, continuing to shoot up go down. You might want to get out when it breaks the lows here at 55. You made 25 pips in that trade and you're out. Now, if you expect after a pullback the market to go up, let's scroll to the sideways here. There's a decent percentage of them going down, not with much intensity. Alright, it stopped going down. Let's say you wanted to buy right here. You never know if a trade's going to work out in real time. You put your stop right underneath the low. But if it goes above these bars highs and you're in, and you see a good percentage of pound pairs going up, yen pairs going down, and doing so with momentum, guess what? You know to hang on to that trade for at least one more bar. See what happens. Right? Notice this one just kind of inched its way up. Good participation without much volatility. Alright, again, a slightly smaller percentage of pounds pairs are going up, yen pairs are going down, but with slightly increased volatility. Again, it's inching its way up, but the tipping point is actually showing down. Even though this one kind of made a higher high and it closed up, other pound pairs are starting to break down. So you can tighten your stop in that instance because this trade's less likely to work. So when trades don't work, this tool kind of lets you see that, and you can get out with a smaller loss than you would normally without this tool. And a lot of times they go up, go sideways for a little bit, and then there's a big, explosion. That most pullback trades don't automatically explode up immediately. But when they do, you'll know it, and you'll know the likelihood of it breaking through the high over here. The market's going sideways right here. Notice other pound pairs are kind of tipping down, the volatility's down. You might decide to just get out of your trade here with 2 or 3 pip profit, or move your stop up even to break even. There's no reason to lose your initial 7 or 8 pip loss on a trade that doesn't, show the likelihood going your way. And see, and you get stopped out. Let's say you're trading this day. You just start trading around 6 o'clock. The market shot up, and then it came crashing down, and then it came up again. Let's face it, this direction, this market could easily go either way. Typically most people avoid currencies that are trending up and then all of a sudden fall through a floor, then rally up again, and then on the way down they don't explode down again. You would expect after a drop like that it wouldn't have even gone back up that high, and if it did, it's likely to continue its previous trend. So as it goes sideways right here, notice the last momentum moves were to the upside. There's a very small percentage of pound pairs going down and dollar pairs getting stronger, and they're inching their way down. Very small percentage of them are participating in the down move, and with almost no volatility. So the last move was up, the pullback trade is down with no intensity. You have intensity up, no intensity down, and when it breaks out right here, notice most of, in fact even before the breakout right here, notice this bar right here, one of the highest percentage of pound pairs going up, dollar pairs going down in the last 6-7 hours, and it goes sideways after that. Even though these bars didn't make higher highs, other ones did, and the close was up on a decent percentage with other pound pairs. So in other words, the pound isn't really stronger than the dollar right now, but the pound is stronger than other currencies, and the dollar is weaker than other currencies, and within 10 minutes you got this breakout. In this instance, it kind of gave you a 10-minute head start to get into this trade, and the market shot up from 50 all the way up to 90, and as it's going up here, notice the percentage participation goes down, the volatility is low, and so you might have exited this trade with 20-25 pips and count yourself lucky. During this little down bar right here, there's no weakness on other pound pairs, both in terms of percentages and intensity. And after this little pullback right here, 2-bar pullback, you buy the breakout right here, and initially they start to spike up with decent volatility, and as it goes up here, guess what? The percentages go down, volatility goes down. You count yourself lucky for having got in here at 70 and out at either 90 or 95. You made 20 to 25 pips on that trade, and it lets you know in real time that other pound pairs weren't excessively strong, dollar pairs weren't excessively weak, and they moved to a much less than average amount for this time of the day. And so you know that this is not likely to explode up. If you got out of this trade with 20 pips, you know it's not likely to shoot up another 30 pips on you, and you're sitting there wondering why you're such a wimp and bailing on a trade too soon. When the trade works, you see a high percentage participation with high intensity, and typically the bars just go, go, go. And on most trades, they don't shoot 30 and 50 pips, but you can take 5 to 15, 25 pips out of the market by recognizing that the odds do not favor a continuation of that trend. So you take, whether it's 3 to 5 pips or 10 to 15 pips, or in this case 20 to 25 pips, you take what the market bears and you tighten your stop, and sometimes you get stopped out and other times the market goes sideways and then continues.